Hello, and welcome to the next edition of Z School. Today we have a case study about a company with 20 million in annualized revenue and 6x revenue growth and zero outside investors. Today I'm going to show you that revenue growth is a vanity metric and that unit economics are more important than the P&L. Hi, I'm John Zanowski, and my mission is to help everyone see their business better with weekly accounting. Weekly accounting is a system to help you see your business better based on unit economics. So today's video is about using unit economics to set your customer acquisition cost. So here's the monthly ad spend of this company from July of 2023 until now. You can see it dramatically increase its spend in September and October. Correspondingly, its new customers also dramatically increased, but its customer acquisition costs skyrocketed. So the question is, how do you set a profitable customer acquisition cost and communicate it to your ad agency? So the answer is that lifetime gross profit sets the CAC target. So for this company, it has 4.3 purchases per customer, an average order value of $84, and a gross margin of 29%, which leads to a lifetime gross profit of $106. In the first video of the series, I show how we calculate those. So now let's turn those unit economics into a P&L by customer. So 4.3 purchases per customer times an average order value of $84 is lifetime revenue of $361. With a gross margin of 29%, that's a lifetime gross profit of $106. So let's continue down the path. So now from that lifetime gross profit, we subtract the customer acquisition cost of $33 to get to a contribution per customer of $73. And this is what happened for this company in Q1. So its contribution margin per customer was 20%, and its lifetime gross profit to CAC ratio was 3.2. Let's watch what happens in the next quarter. In the next quarter, it increased its ad spend a little, and its customer acquisition cost went up. So its contribution margin went down a little, and its lifetime gross profit to CAC went down a little bit. It's still okay. But in Q3, they spent a lot more aggressively, and the customer acquisition cost tipped over into some unprofitable territory where the lifetime gross profit to CAC ratio dropped below 2. In October, it really fell when they dramatically increased their spend. Their customer acquisition cost went all the way as high as $93, and their contribution margin was almost break even. And that's why the company was showing declining profitability. Running with unprofitable unit economics is not investing in the business. It's spraying cash out the muffler to make your car go faster. So let's continue and look at the P&L by customer. And this is when it was good. So let's drill in there. During those quarters, we spent between $262,000 and $325,000 on Facebook. So the on-platform Facebook ROAS was between 71 and 53. Please note that the on-platform Facebook ROAS has actually nothing to do with what happens on your financial statements. It's just an index that's created by Facebook that corresponds to numbers that you type into Facebook, but it has no bearing on the actual reality of your financials. So if we want to optimize for contribution margin, then we would maintain a customer acquisition cost of less than $45. And we were able to do that when we were spending $325,000 per quarter. So that means you should spend less than $25,000 per week and maintain an on-platform ROAS greater than 53. So here's how CAC and on-platform ROAS relate. Customer acquisition cost requires data from multiple applications, and that makes it not real time, but it is tied to cash and it is accurate. On-platform ROAS, on the other hand, is measured on the platform in real time, but it's not tied to cash, but it is directionally correct. So when giving advice and limits to your ad agency, you should give them direction based on the on-platform ROAS. But now, if I have to reduce my ad spend, my business will shrink. That's exactly right. Every channel saturates. And the business size is not limited by the size of its market. It's limited by the size of the channels through which it can profitably acquire customers. Take this company, for example. It spent $300,000 acquiring 1,600 customers in a month, and then the next month it spent $350,000 to acquire 1,600 customers. Clearly, the channel is saturated and it should spend less. So what's next for this company and for really every company in the direct-to-consumer space at this point? The Facebook ad channel is getting more and more saturated every day. So everyone should maximize their contribution from the Facebook channel by reducing their ad spend and either raising prices or reducing discounting if you can to get the lifetime gross profit to CAC greater than 2. And then we should find new channels to grow. If you'd like to learn more about this, you can book a meeting with us at weeklyaccounting.com. And if you connect your systems, we'll do this analysis for you as a gift. And if you send me an email to z@weeklyaccounting.com, I'll send you a free copy of the book I've written called Zen and the Art of Nothing. Here's one of the poems from the book. It starts with an intention and it turns into the word. Sample progress in a rosette, precise like hummingbird. Compare the rosette to an intention and accounting every week. Make predictions of the future. The system then will seek. If it's not good, then you will know exactly what to do. Your mind or the system has to change, and the fix is up to you. Thanks for watching.